What if the biggest economic trick in Europe's modern history is happening right now, silently, while most people still believe interest rates work the way they were taught in school? What if the erasure of massive government debt is not a future scenario, but an ongoing process hidden behind technical language, central bank decisions, and policies that appear harmless on the surface? This is where the story becomes unsettling, because the moment Europe embraced negative interest rates, it crossed a line that changed the entire financial logic of the continent, and almost no one outside financial circles realized what that actually meant. Negative rates were not a quirky experiment. They were a structural weapon designed to dissolve debt without public resistance, slowly rewriting the rules of savings, borrowing, and state finance. To understand how this worked, you have to imagine a world where money loses value not through inflation alone, but through policy intention. Governments across Europe were drowning in obligations after years of stagnation, crisis responses, and demographic pressure. Paying back debts the traditional way would have required political sacrifice, spending cuts, or higher taxes, all deeply unpopular. But negative rates created a different pathway, a shortcut hidden in plain sight. When central banks pushed rates below zero, they effectively changed the relationship between creditors and debtors. Suddenly, holding government debt became a cost for institutions, not a benefit. And that shift began transferring value from savers to states in a way that felt frictionless, almost invisible. People saw headlines about unusual monetary policy, but few understood the consequences. Banks holding reserves at the central bank watched their margins shrink. Pension funds struggled to meet return targets. Ordinary savers found themselves earning nothing, sometimes less than nothing, without ever realizing that this loss was the hidden tax. That made government balance sheets look healthier. Every percentage point below zero erased billions in liabilities over time, and because it happened gradually, spread across the entire financial system, the public never connected the dots. That is the brilliance and the danger of this mechanism. Debt is dissolved through silence rather than confrontation. Have you ever wondered whether policies that look harmless on paper might actually reshape your financial reality in ways no one fully explains? If you want to share how this idea resonates with your own experience, leave a comment, drop a like to help this message reach more people, and take a second to check if you're already subscribed so you do not miss what comes next. The next part will pull the curtain even further, revealing how these mechanisms expanded into something even more powerful and even more hidden. The deeper you look into Europe's shift toward extreme monetary policy, the clearer it becomes that negative rates were never the end goal. They were the entry point, the psychological breaking point, the moment when central banks realized they could redesign the flow of money without triggering public revolt. Once the precedent was set, the next phase unfolded quietly, an era of extraordinary monetary expansion where the European Central Bank began purchasing government bonds on a scale so massive that traditional market principles simply stopped applying. This wasn't just stimulus, it was an engineered financial environment where demand for sovereign debt would never disappear because the buyer at the top of the system could print purchasing power at will. Behind closed doors, policymakers admitted openly what they never explained publicly. The only way to keep European governments functional was to suppress borrowing costs indefinitely. Countries that should have faced soaring yields instead watched them fall to levels that made borrowing painless, sometimes even profitable. When a government can issue debt at near zero or below zero, the fundamental meaning of obligation shifts. Debt no longer represents a burden. It becomes a tool that can be expanded indefinitely as long as someone guarantees demand for it. That someone was the central bank, and its interventions transformed entire national budgets overnight. This new reality changed behaviors across the financial system. Banks adjusted their models. Insurers recalibrated their expectations. Bond traders stopped thinking in terms of risk and started thinking in terms of central bank footprints. Debt issuance surged because there was no penalty for excess, and with every new round of asset purchases, the ECB absorbed more of the continent's liabilities, quietly transferring them from public markets into a zone where political pressure could never touch them. The public heard phrases like quantitative easing and balance sheet expansion, but rarely understood that each wave of purchasing diluted the traditional value of debt and slowly rewrote the rules of fiscal responsibility. What makes this even more striking is how little debate surrounded the shift. Economists warned of distortions, but policymakers framed the actions as temporary, exceptional, necessary for stability. The truth is that once the mechanisms became embedded, stepping away from them would have unleashed consequences no government was willing to face. Market interest rates would have surged, borrowing costs would have spiked, and the illusion of control would have shattered. Instead, the system adapted, absorbing the imbalance and normalizing conditions that once would have been unthinkable. And just beneath the surface, a new layer of financial engineering began to take shape. one that pushed Europe even deeper into a structure where the old rules held no power, and the cost of failure would grow larger with every passing year. As Europe sank deeper into this new monetary architecture, another mechanism began reshaping the landscape from within, the silent compression of yields across the entire bond market. This was not simply the result of central bank purchases, it was the behavioral chain reaction that followed. When the ECB absorbed vast volumes of government debt, traditional investors were forced into a desperate search for returns, pushing them toward riskier assets they previously avoided. Pension funds, insurance companies, and sovereign wealth funds found themselves holding instruments that carried more volatility, more uncertainty, and far less transparency than the bonds they were used to. Yet they had no alternative, because safe assets had become both scarce and unprofitable. This shift created an environment where risk was no longer priced naturally, but engineered through policy intention. Markets lost their ability to self-correct, because price signals were drowned out by central bank intervention. When a system cannot rely on natural incentives, it begins to drift slowly towards structural fragility. In Europe, this fragility appeared in subtle ways: distorted valuations, inflated corporate borrowing, silent bubbles forming in sectors that had never experienced speculative pressure. Companies that should have struggled to survive suddenly found cheap financing at their fingertips. Governments that once feared voter backlash from fiscal mismanagement discovered that debt carried almost no immediate consequence, encouraging them to postpone reforms indefinitely. Yet the public narrative remained reassuring, almost overly confident. Policymakers spoke about stability, resilience, and coordinated strategy, but the truth was that Europe had entered a financial reality that required perfect choreography to maintain balance. Any disruption, any unexpected surge in inflation, any geopolitical shock could send tremors across the system because the foundations were no longer built on organic market forces. They were built on a carefully managed illusion of calm. What made the situation even more complex was the psychological dimension. Once investors, citizens, and institutions adjusted to a world where rates were permanently suppressed, expectations hardened. People began to view this environment as normal, forgetting that, historically, such conditions would have been considered extraordinary or even alarming. This collective acclimation was not accidental. It was a byproduct of repetition, messaging, and the gradual fading of alternatives. And as comfort grew, oversight weakened, giving policymakers room to construct yet another layer of financial engineering that would tie Europe even more tightly to the system it could no longer step away from. As the system evolved, a quiet transformation unfolded inside the European Central Bank itself, one that reshaped its role from guardian of monetary stability to an active redistributor of wealth across the continent. The shift was subtle enough to escape public awareness, yet powerful enough to alter the economic fate of entire nations. When the ECB began purchasing not only government bonds but also corporate assets, the traditional hierarchy of winners and losers started to blur. Capital flowed towards sectors favored by the policy framework, while others were left to absorb the pressure of an artificially altered marketplace. This was not redistribution through taxation or legislation. It was redistribution through mechanics that operated far from parliamentary debate. Banks understood the implications early. With the ECB anchoring yields and injecting liquidity, financial institutions suddenly had access to cheap funding that allowed them to expand lending, restructure balance sheets, and offload risk in ways that would have been impossible under normal market conditions. Meanwhile, ordinary households, lacking access to the instruments that benefited from this environment, experienced the opposite effect. Their savings stagnated. Their purchasing power eroded quietly. Their exposure to rising asset prices pushed essential goods further out of reach. The gap between those plugged into the financial engine and those surviving outside it widened with every intervention. Yet the narrative remained centered on stability and necessity. Corporations that issued debt found themselves in a golden era. Borrowing costs fell so low that refinancing became a strategic advantage rather than an operational chore. Even firms with weak fundamentals accessed credit at rates that ignored the true level of risk they carried. Some used the windfall to expand, others to delay restructuring, and others simply to survive longer than market logic would normally allow. The invisible hand that once allocated resources based on merit and performance had been replaced by a centralized pulse that rewarded scale and proximity to financial markets. Governments, observing these effects, adjusted their strategies accordingly. With borrowing costs suppressed, they leaned on debt to cover structural weaknesses, funneling resources into programs that maintained political stability without addressing underlying inefficiencies. The ECB did not merely support this behavior, it enabled and reinforced it. The more debt governments issued, the more the ECB absorbed, creating a cycle that detached fiscal reality from economic consequence. Yet the public rarely interpreted this as redistribution, because the mechanism lacked the visible friction of taxation. It operated through balance sheets, interest flows, and valuation shifts that few people tracked closely. The silence surrounding these dynamics became part of the design. Policies that would have sparked outrage if implemented directly passed unnoticed because they were embedded in technical decisions, acronyms, and spreadsheets far removed from daily life. And as this silent redistribution deepened, the system prepared its next transformation, one that would rely not on expansion, but on the strategic management of perception and financial narrative. If this perspective sparks a thought or challenges something you believed about how these systems work, share your comment and let me know what part of this hidden architecture caught your attention. As the silent redistribution took root, the first unmistakable fractures began to appear not in government accounts, but in the daily reality of citizens. The official narrative insisted that inflation was temporary, controlled, or even harmless, yet the lived experience across Europe told a different story. Prices drifted upward, not in sudden spikes, but in slow, persistent waves that eroded purchasing power steadily enough that most people could not pinpoint the moment things changed. Inflation became the invisible cost of keeping the system stable, a pressure valve that quietly transferred value away from households and toward the financial mechanisms absorbing the burden of government debt. But inflation alone was not the only distortion forming beneath the surface. Asset markets inflated with a disconnected logic, creating an environment where the price of housing, equities, and even basic commodities rose faster than underlying productivity. Cheap borrowing fed speculative cycles, encouraging corporations to take on debt not to innovate, but to buy back shares, acquire competitors, or expand into markets that offered little long-term value. The signals that once warned investors of excessive risk became blurred, overwritten by the assumption that central banks would intervene long before any real damage occurred. For ordinary individuals, these distortions produced a slow tightening of daily life. Housing became increasingly unaffordable, especially in major urban centers where demand collided with speculative capital searching for yield. Young generations entering the workforce faced a landscape where wages lagged behind living costs, pushing them toward debt as a survival tool rather than a strategic choice. Savings accounts, once seen as safe havens, turned into stagnant pools where money lost value silently year after year. People felt the pressure, but rarely understood its origin, because the connection between macro policy and household reality remained hidden behind layers of financial terminology. Even businesses encountered strange new dynamics. Small and medium enterprises struggled to compete against large corporations that benefited disproportionately from low borrowing costs and central bank asset purchases. Markets tilted in favor of scale, not efficiency or innovation. Entire sectors began consolidating, not because of natural competitive forces, but because monetary architecture tilted the playing field. This shift created the illusion of growth while weakening the diversity and resilience that healthy economies rely on. Through all of this, policymakers continued presenting reassuring messages, emphasizing stability and long-term vision. Yet, beneath the calm exterior, Europe was drifting into a structure where normal corrective mechanisms no longer functioned. The financial ecosystem relied increasingly on engineered signals, managed expectations, and the belief that intervention would always arrive in time. And as these imbalances grew heavier, another layer of dependency began to form, one that pushed Europe into a future where stepping back from these extreme policies would become more dangerous than continuing them. The deeper Europe moved into this engineered financial landscape, the more clearly a new hierarchy of beneficiaries emerged. At the top were institutions perfectly positioned to convert distorted monetary conditions into strategic advantage. Large banks, multinational corporations, and investment funds began operating in an environment where risk was softened, borrowing was effortless, and the cost of capital no longer reflected economic reality. These players understood something the public had never been told directly. The structure of negative rates and aggressive asset purchases was not only dissolving government debt, it was simultaneously amplifying the power of those closest to the financial engine. Banks, for example, adapted with remarkable speed. Even as margins on traditional lending shrank, they shifted toward fee-based services, asset management, and balance sheet optimization strategies that thrived under the new regime. With central banks acting as backstops, banks faced a world where liquidity crises were unlikely and refinancing risks were minimized. This allowed them to expand influence, consolidate competitors, and embed themselves even deeper into the financial architecture that relied on their cooperation to maintain the illusion of stability. Multinational corporations benefited just as dramatically, though in a different way. The ability to issue debt at historically low costs created an era of unprecedented corporate leverage. Companies refinanced old obligations, extended maturities, and built war chests that allowed them to weather downturns, acquire rivals, or invest in projects that would have been unthinkable under normal market conditions. Their financial strength became less about operational performance and more about proximity to cheap liquidity. The market rewarded size, predictability, and access to capital over innovation or productivity. This shift was not visible in quarterly reports, but its influence shaped entire sectors. Investment funds, too, found fertile ground. With safe yields evaporating, they were pushed into alternative assets, derivatives, and complex financial products that promised higher returns. The appetite for yield drove capital into markets that were never meant to absorb such volume, inflating valuations and increasing interconnectedness. A single shock in one asset class could now ripple across multiple regions, precisely because the incentives created by monetary policy had blurred the boundaries between risk categories. Meanwhile, governments observed this new distribution of power with a mix of relief and dependence. The success of their financing strategies relied on the stability of the very institutions that benefited most from the system. Any disruption to banks or corporate credit markets could jeopardize the delicate balance holding public finances together. This created an implicit alignment between policymakers and financial giants, reinforcing a cycle where interventions supported not only macro stability but also the continued strength of those at the top. Yet beneath the surface, this alignment introduced a vulnerability that few were willing to confront. By concentrating influence within a narrow set of financial actors, Europe built a system where resilience depended on the behavior, discipline, and stability of participants, who were incentivized to maximize gains inside a protected environment. And as the structure expanded, the consequences of any misstep grew larger, pushing Europe into an even tighter web of monetary dependence that would soon reveal its underlying fragility. As Europe expanded this monetary framework, another silent mechanism emerged, one that rarely appeared in official statements but shaped every political decision behind the scenes: the dependence on public ignorance. The success of negative rates, massive asset purchases, and debt absorption relied heavily on one condition that policymakers never articulated openly. The system worked only if the average citizen never fully understood how or why it worked. Complexity became a strategic barrier, a shield that kept the public from questioning policies that fundamentally reshaped their financial reality. Central banks mastered this approach through language. Reports became longer, terminology more specialized, and explanations increasingly wrapped in abstractions that sounded technical enough to discourage scrutiny. Concepts such as liquidity coverage ratios, collateral frameworks, and long-term refinancing operations formed a dense wall between the policy and the people. The opacity was not accidental, it was functional. The less the public understood, the easier it became to guide expectations, manage reactions, and maintain trust in institutions that were quietly rewriting the rules of the economy. Governments complemented this strategy through narrative framing. Instead of discussing the structural consequences of unconventional monetary policy, they focused on external events, crises, disruptions, global trends, unpredictable shocks. These explanations created the impression that Europe was responding to forces outside its control, not designing internal mechanisms that would permanently transform the financial system. By controlling the narrative, governments avoided political backlash, while central banks pursued interventions that, if presented plainly, would have sparked widespread debate. This dynamic created a subtle psychological contract. Citizens accepted the idea that experts were managing the complexity of modern finance. In return, policymakers used this trust to implement solutions that prioritized system stability over individual financial clarity. The distance between decision makers and the public widened, not through explicit policy choices, but through layers of technical language that insulated institutions from accountability. The irony is that the more the system relied on secrecy, the more fragile it became. Public understanding is not just a democratic ideal, it is a stabilizing force. When people grasp how economic structures function, they adapt better to shocks, identify emerging risks, and hold leaders accountable. But when policies operate in the dark, resilience depends entirely on institutional competence and coordination. Any internal misstep, communication failure, or unexpected event can trigger confusion and mistrust that spreads faster than the institutions can contain it. Yet even as these vulnerabilities accumulated, Europe pressed forward, building an economic architecture that demanded absolute control over perception. Every new intervention relied on the assumption that the public would continue accepting complexity as a substitute for transparency. And with that assumption in place, the next phase of the system began to take shape, one where the boundaries between monetary strategy and political survival blurred. Even further, if any part of this invisible dynamic resonates with you or sparks a reaction, share your thoughts in the comments and let me know which part of this hidden structure feels most revealing. As Europe continued relying on policies that blurred the line between monetary engineering and political necessity, the architecture of the system became increasingly dependent on one uncomfortable reality. There was no path back to the old economic model. The moment negative rates, perpetual, asset purchases, and liquidity injections became embedded in the foundation of European finance, they created a structural trap that made reform not only difficult, but dangerous. Any attempt to unwind these measures risked pulling tension through every layer of the economy, exposing weaknesses that had been suppressed rather than resolved. One of the clearest signs of this trap emerged when policymakers quietly acknowledged that even small increases in interest rates could destabilize government budgets across the continent. Years of ultra-cheap borrowing had inflated debt levels to heights that were manageable only under artificially low yields. A return to historical averages would make refinancing impossible for several countries without triggering fiscal crises. This meant that the ECB was no longer simply guiding economic conditions. It had become the final pillar holding the entire system together. Stepping back was no longer an option. At the same time, asset markets had grown accustomed to intervention. Investors built strategies around the expectation that liquidity would always be available and that downturns would be softened by policy support. Corporate planning relied on predictable financing conditions, and banks structured balance sheets around assumptions that would collapse if rates normalized. The system had evolved into a tightly woven network of expectations, each dependent on the continuation of the previous phase. Stability no longer came from market resilience, but from the belief that intervention was permanent. Households, too, became entangled in this new reality. With rising living costs and stagnant wages, many turned to credit as a buffer, relying on low rates to maintain consumption. Mortgages, loans, and personal debt were all calibrated to an environment that assumed financial conditions would remain favorable indefinitely. A shift in policy would not simply tighten the economy, it would reshape daily life for millions, creating ripple effects that would pressure governments to reverse course before the consequences became visible. What made the situation even more complex was the political dependency that quietly formed around the system. Leaders across Europe relied on cheap financing to maintain social programs, stabilize budgets, and avoid confrontations with voters already fatigued by years of economic strain. Any disruption to the monetary framework risked triggering political instability, making policymakers increasingly reluctant to consider alternatives. The system had become self-reinforcing, with each round of intervention justifying the next. This is how Europe found itself in a cycle where returning to previous norms was no longer feasible. The architecture of modern European finance had been rebuilt around the assumption of continued support, and unwinding that support would expose vulnerabilities that had been accumulating in silence. As the pressures intensified, the next phase of the cycle began to surface, marked not by expansion, but by signs that the structure itself was reaching the limits of what monetary engineering could hold. The signs of strain did not appear suddenly. They emerged in subtle anomalies scattered across the system like quiet alarms that only those paying close attention could hear. At first, the warnings looked like routine fluctuations, small divergences in bond markets, unexpected liquidity gaps, fragile moments during political uncertainty. But each signal hinted at a deeper tension forming beneath the engineered calm. Europe had constructed a monetary architecture that depended on flawless coordination, predictable narrative control, and unwavering public trust. Yet markets began revealing that the facade could not be sustained indefinitely. One of the clearest indicators was the growing instability in sovereign debt spreads. For years, intervention had compressed these spreads to unnatural levels, masking the underlying differences in fiscal strength between nations. But as inflation persisted and geopolitical pressure mounted, investors began questioning whether the European Central Bank could continue absorbing risk at the same scale. Even small widening in spreads carried a message. The market was beginning to reassert itself, testing the limits of artificial suppression. If spreads normalized too quickly, the refinancing burden on highly indebted countries would become unmanageable. Another warning sign surfaced in the banking sector. Institutions that had adapted to years of low margins suddenly faced an environment where their balance sheets were exposed to the very distortions that had kept them afloat. Rising rates threatened the value of bond portfolios accumulated during the era of ultra-cheap financing. At the same time, credit demand from households weakened as living costs surged. Banks found themselves squeezed between market pressures and structural vulnerabilities, created by the policies that had once supported them. This emerging fragility revealed how deeply interconnected the system had become, where stress in one corner reverberated throughout the financial network. Capital markets also began showing signs of exhaustion. The search for yield had pushed investment funds into increasingly complex instruments, many of which depended on stable conditions to function properly. When volatility returned, even briefly, it exposed how thin the margin for error had become. Hedge funds faced liquidity constraints, pension funds struggled to meet obligations, and insurers reassessed risk models that had been built on assumptions no longer aligned with reality. Each episode of volatility triggered behind-the-scenes interventions, reinforcing the idea that the system could not withstand shocks without support. Even households began signaling strain through rising default risks and declining consumer confidence. Mortgages issued at historically low rates became a source of anxiety as payments crept upward. Families that had relied on credit to offset stagnant incomes found themselves navigating a tighter financial landscape. These pressures did not create immediate crisis, but they formed the undercurrent of a deeper problem. The system could no longer absorb additional stress without revealing the weaknesses hidden through years of monetary engineering. All these signals pointed to the same truth. Europe was approaching a threshold where the mechanisms designed to stabilize the system were now contributing to its fragility. And as these tensions accumulated quietly across markets, institutions, and households, the final stage of the cycle began to take shape, not through dramatic collapse, but through the gradual unraveling of the assumptions that had kept the system suspended for so long. As the pressures accumulated across every layer of the European financial system, a quiet transformation unfolded, one that revealed the final piece of the strategy. Debt was not being solved, repaid, or restructured. It was being absorbed, diluted, and repositioned until its weight no longer appeared on the surface. The disappearance of massive obligations did not come from economic growth or fiscal discipline, but from the gradual erosion of real value across currencies, savings, and long-term financial instruments. Through negative rates, bond purchases, and engineered inflation, Europe discovered a way to make liabilities fade without announcing that the cost had been transferred to the public in ways too subtle to provoke resistance. Central bank balance sheets became the vault where unwanted debts were stored, a space outside traditional political scrutiny. Once inside, these obligations no longer behaved like normal liabilities. They sat in an environment where repayment schedules, market discipline, and investor expectations no longer applied. The more debt the ECB accumulated, the more insulated governments became from the consequences of overspending. Over time, the boundary between public finances and monetary policy blurred, creating a structure where national budgets relied not on the strength of the economy, but on the capacity of the central bank to absorb and neutralize excess. This process reshaped the meaning of money itself. Currencies that once reflected productivity and fiscal responsibility now reflected the delicate balance of policy decisions designed to maintain stability. The euro became a tool of preservation rather than expression of economic reality. Its value depended not on competitive markets, but on the credibility of institutions operating behind layers of complexity. The shift allowed debts to fade quietly, but it also emptied the traditional signals that once guided economic behavior. Households tried to save, unaware that real value was slipping away. Businesses invested, not because conditions improved, but because liquidity was abundant. Markets rallied, not through organic growth, but through expectation of intervention. In this environment, the disappearance of debt was almost invisible. Budgets looked healthier, yields stayed low, and the system presented an image of sustainability. But beneath that calm surface, the cost had already been distributed across millions of people whose financial reality shifted slowly enough that the true impact was difficult to trace. This was the final stage of the cycle. Debt erased through silence, absorbed through inflation, and stabilized through the constant presence of a central authority that could never fully step back without exposing everything the system had hidden. If you reached this point and felt the weight of how these mechanisms shape your world in ways few ever explain, leave a comment with the phrase, "I am with you until the end," so I know you followed this journey. If this deep dive brought clarity, consider subscribing so you can stay connected as we uncover more layers that rarely surface in public conversations, and give a like if this perspective helped you see the system differently. There is another video here that continues this line of thought in a way that ties directly into what you just discovered. So step into it and keep moving forward with me.